What if I told you that there's this treasure trove of company secrets just sitting out there in the open, available to absolutely everyone for free, but that 95% of investors just completely ignore it? Well, it's true. And today we're going to pull back that curtain and show you exactly how to use it to get a massive, massive edge.
Okay, let's start with a number, a really, really big one. $3.5 trillion. That's how much money retail investors, people just like you and me, pour into U.S. stocks every single year. It's just an almost unimaginable amount of cash flowing through the market. But here's the wild parts. Fewer than 5% of those investors, 5%, ever actually read a company's official filings before they click that buy button. And that creates this huge knowledge gap. And let me tell you, the cost of being in that gap can be absolutely devastating.
I mean, think about the biggest corporate blow-ups of our time. Enron, Lehman Brothers, and more recently, Silicon Valley Bank, and even FTX. In literally every single one of these disasters, the warning signs, the big flashing red flags, they were right there in their public filings, sometimes for months or even years before the whole thing came crashing down. Now, this is a really crucial distinction to understand. A press release, that's just marketing. It's the company's dating profile, all the good stuff. An earnings call is basically a performance. But these filings? Oh no, these are sworn legal documents. Executives can literally go to jail for lying in them. This is the closest you will ever get to the raw, unvarnished truth about a company. So, how do we actually close that information gap? Well, it all starts with understanding the two most important documents out there for any investor, the 10K and the 10Q. The easiest way to think about it is this. The 10K is like the company's full, deep dive annual physical exam. It's comprehensive, it's audited by outsiders, and it gives you the complete blueprint of its health. The 10Q, on the other hand, that's more like a quarterly pulse check. It's shorter, it's unaudited, but it gives you those really timely updates so you can track what's changing. Smart investors use the K for the deep context and the Qs to make sure nothing's going off the rails. Okay, I know exactly what you're thinking. Man, I do not have time to read a 200-page legal document. And you know what? You don't have to. I'm going to give you a super high-impact 20-minute strategy to quickly scan for those red flags and get an almost instant read on a company's health. All right, here's the game plan. First, you're going to open that filing and jump straight to Item 1A, Risk Factors. Don't skim it. Look for what's new, what's been added, or what suddenly moved way up the list. That tells you what's keeping the execs up at night. Second, find the auditor's opinion. You are looking for two magic words, unqualified opinion. Anything else is a huge warning. And finally, scan the section on liquidity. Is the company just burning through cash? Are they making money from their actual business? This is basically the financial truth serum. So the key takeaway here, and this is probably the most important thing I'll say, is do not read these things like a book from page 1 to the end. That is the single biggest mistake people make. You have to be a financial detective. You start where the company is legally forced to tell you everything that could possibly go wrong. Okay, theory is all well and good, but let's see how this works in the real world. We're going to take a look at Silicon Valley Bank's final 10K, the one they filed just a few weeks before they completely imploded, to see what a disaster actually looks like on paper. Boom, right there, in black and white, filed on February 24th, 2023, the bank flat out admitted it was sitting on over $15 billion in paper losses on its bond portfolio, all because interest rates went up. This wasn't some hidden secret, it was a public disclosure for anyone who cared to look. But wait, it actually gets worse. A lot worse. Just look at this chart. A staggering 90%, 90, of all their deposits were uninsured. They were over the government's limit. This created an unbelievably fragile situation. All it would take is a handful of their big tech clients to get nervous and pull their cash, and the whole house of cards would collapse. Which, of course, is exactly what happened. So let's just put this on a timeline, let it really sink in. February 24th, the 10K, with all these massive warnings is filed. The stock is trading at $267 a share. Just 16 days later, 16, on March 10th, the bank fails. The stock is completely worthless. The information was there. The map to disaster was published for everyone to see. So why does all this matter for you? Because learning how to do this simple scan isn't just about dodging bullets and avoiding disasters. It's about giving yourself a powerful, brand new competitive edge as an investor. This chart honestly says it all.
The overwhelming majority of the market, 95%, is just reacting to headlines, to tweets, to fleeting sentiment. But that tiny 5% slice, those are the people who go to the source. That is where the real, sustainable advantage is found. You can be in that group.
And you know the best part? All of this information, it's completely free, it's all public. The only investment it takes is a little bit of your time and your curiosity. That huge gap between what the talking heads are saying on TV and what's officially disclosed in these documents, well, that gap is your edge. So, I guess that just leaves one question. Now that you've seen how powerful this is and you know exactly where to look for the good stuff, which company's 10K are you going to investigate first?